I'm the vice chair of education and also a program director, like a lot of you are. So it's a great group. I find it really difficult for people in education to really have influence in these financial matters sometimes. Anybody else find that difficult? I mean, sometimes your admin people, your department people, they just, that's an educator person. So that really helped me go back to becoming, getting an MBA, because I think that really launched a little bit of at least my ideas. I will tell you one thing I just read. I thought it was a good thing to use with this group. With this type of course, much like an MBA, it really reminds me of something I read in a Patrick Lencioni book. So it's about organizational health. So the way this starts out is, everybody familiar with I Love Lucy? So Ricky comes home. He sees Lucy crawling on her hands and knees in the living room. And he says in his Cuban accent, "What are you doing?" And she says to him, "I'm looking for my earrings." And he goes, "You lost an earring in the living room?" She says, No. I lost it in the bedroom, but the light is much better here. So it reminded me that, realize that organizations tend to operate in the place where the light is. So this, if anything else, this kind of course and these talks you're going to hear, an MBA, it really makes you think of getting out of your comfort zone a little bit, where the light maybe is not, but where you can really have a big impact. So anyway, I hope to become familiar with some financial language. You heard some of the terms already. I'm going to reiterate some of those, but I'll go over them pretty briefly. We're going to talk about how people make decisions about investing, about acquisitions, things like that a little bit. And these are done in healthcare systems. And also, we'll go through a couple of examples. And then hopefully this will whet your appetite to try some of these projects and some of this way of thinking in your own institutions. Anybody know who this is? Yeah, it's Warren Buffett, right? And what's the name of his big company that Berkshire Hathaway. I put him up there because he obviously has made great acquisitions, great investments, but he also has some themes to his life, right? Puts a lot on reputation. He's the one who coined the idea that don't do things that you, or don't be unprofessional. Don't do things that you would not like seeing those things on the front page of a newspaper. So anyway, his acquisitional concept is that people become partners. So it's just a little bit different philosophy, but obviously very wealthy, very successful. These are terms you've already heard a little bit. We're going to go through some of these. Particularly, let's see if I can get this right. Particularly these few terms down here, we're going to learn how to calculate those. We're going to go through some examples of how you might do a calculation. And believe me, if your system is growing like every system in the room probably is, they're doing these things, okay? So, anyway, so first thing is return on investment. You've heard this already. This is right out of like, it's gain from your costs. It's generated earnings over amount invested. You heard this already, from Brahim. So, it's positive, obviously, if there's more profits. If there's a lot of losses, it's negative, right? And we'll get you these slides too, by the way. Let me go back one step. So some revenue indicators are things that you've heard of called gross margin. Okay, another really important definition. This has to do with total sales over cost of goods sold over total sales revenue, and it's a net gross margin. Anytime you put the word net in it, now you're subtracting some important things, whether it's taking account for taxes or other expenses, but you subtract that from the gross margin to get the net margin, okay? Profit margin is simply the net income over your net sales or your revenue. So what is your income going to be? And your net income then just takes your total earnings, which is revenues minus costs. So these are quick and easy terms, and I'm sure that you have seen these before or somewhat familiar with them. And Brahim mentioned a few of them too. But this is just a really basic way to think about assets, liabilities, and equity. Because I think that you hear these terms over and over again, and it's hard to know what people are talking about. You already heard what the main assets were. Last talk, it was a great job of doing that. But this is a resource with economic value, that an individual corporation or a country even owns or controls with some expectation that it will provide benefit. Okay? A liability is a debt or obligation that arises from the course of the operations, right? So equity is just simply assets minus liabilities, and that's the equity. Now, if you're talking about a big corporate organization that's on the stock exchange and the stock market, a lot of equity is stock, okay? So it may be assets, it may be that it's your buildings, things like that, or your property, but companies' cost of capital, okay, what is the cost of capital? What is their main cost that they have? It really is talking about your cost of debt and your cost of equity, okay? There's a cost associated with that, and we'll get to that in more detail when we talk about the weighted average cost of capital, okay? Opportunity cost of capital, this is a concept that I tell you, this was one of the hardest concepts for me because it rolls into what the net present value is and how to calculate that. And we're going to get to that, okay? But opportunity cost of capital you should think of as it's the discount rate of how your dollars or your dollar amount is going to be discounted over time. So in a way, it's the dollar amount that's put into something. That dollar amount could have also been invested in the market for a different profit. And that opportunity cost is what you might have to sacrifice to invest in something. That's a simplistic way to look at it, okay? So that's a discount rate over time. It gives the money to invest in a project rather than stocks. Let me see if we can make that a little bit more clear, okay? Here is a kind of a standard way to look at this. If you invest in a market over time, the return rate over several years has been estimated to be around 7%, for example. We'll call that R sub M, okay? Now, if you're going to be a really conservative investor and go in government securities, the 10-year Treasury note is about 2.16% versus Treasury bond, a little bit higher. But those returns are going to be a lot smaller, but they're very fixed. So it doesn't go up and down like the market would be. But we have a market average and we have a conservative average. If we add those two together, we get this kind of required rate of return. So in almost all the formulas to calculate net present value, we use a derivative of this number, right around 9 or 10%. So for some of my calculations I'm going to use, it's not perfect by any means, but it's just to show you how to calculate these numbers. I'm going to use a number close to this. So our estimate in our examples will be about 9%, okay? That really goes to risk, okay? It's what things can earn if you were to invest them in other areas, okay? So if I have dollars, they go down in value because I could have invested in someplace else, okay? Here's right from our textbook that we use in our managerial finance. And the question was, in a survey of CFOs, what do they use to figure out how investments work in projects? In other words, what do they hang their hat on and say, hey, this is a good investment or a bad investment? It turns out that most of them used one of these first two, either net present value, which we're going to get to, or internal rate of return, and they use something called a payback period, okay? These are some other things they use, profitability index, book rate of return, but we're going to really spend some time going through examples of the first three. Anybody have any experience with either net present value or internal rate of return? Anybody seen these calculated or heard about these terms? Fortunately, the person who is the dean of our whole MBA program, Anil Makija, pretty award-winning guy, but he went through this really, really slow, which really helped me. So anyway, so we're going to talk about these. I have some things in here that we'll mention as well, but it's not going to be quite like this. But so net present value is the first thing we're going to talk about. This takes into account what happens or what could happen if the dollar amount that you're investing in a company or in something is invested, out in the market. Okay, so that time money is what really tells you that dollar amount is actually worth less than it is today, because if it were invested in the market, you're getting maximal amounts of return. I'm not doing that, so that money doesn't have the value it could. So we have to discount it by that when we're figuring out some of these acquisitions, okay? So it depends on the forecasted cash flows, and what we talk to is the opportunity cost of capital. So there's a formula that we're going to get to about this, okay? So companies obviously prefer to invest in positive rather than negative net present values. They want the value to be a positive and output or outcome, I mean. Sometimes you can add these, and there's ways to do this if you're talking about more than one investment. And these companies, a lot of times that acquire lots of different organizations, different smaller companies, they have to do this. Okay? So we talked about this discount rate already, and we'll show you a little bit in the formula for this. We already did this rate of return by coming up with a value of about 9.21, although we're going to round it off to 9 in some of our calculations, okay? So to determine the present value, we need to sort of be able to discount future cash flows from whatever we're putting out there. And the two examples I'm going to give you later are going to be a freestanding emergency department and the startup of an ultrasound program in your emergency department, okay? And you probably are doing this already, but I'll show you how some of the calculations would go for this. And by the way, let me ask, of the groups out here, I know the 3 people that are in my cohort are all affiliate or program directors, but how many people out there within their programs or within their departments are going to a freestanding ED? Boy, not a lot of hands. So most of you don't have freestanding ED in the mix of your system, at least not yet. How many of you are considering it? I mean, is the system considering opening one or doing anything like that? I see at least one. Okay. Yeah, the interesting thing was for our system, we proposed one of the first ones in the whole area in Columbus, Ohio, and because they were opening up an outpatient clinic, we should have a freestanding ED. We actually had somebody that went to the same MBA program, 2 people that went to the same MBA program I did, who got a business plan, a pro forma, proposed it, and of course it was rejected. And then everybody else started doing it, and they're making lots of money, so now they're jumping on the bandwagon. I think that's how academic centers work. They're really afraid to be innovative, to do things first, but they really want to get involved. So now they're betting that their brand will be so big that it won't be a problem. So we'll see what happens. So here's a short example. Let's say that you have $100,000. That's your cash flow, a year's worth of income. It's going to be $100,000. Okay. So it turns out that if you discount this at a rate of 10%, what I mean by that is you could have taken that 100,000, invested it in a combination of market and securities, and made that amount 10%. You're essentially losing that amount of money. So you have to take that into account. So then really the present value of that dollar amount becomes this. It becomes that cash flow, which is 100,000 over 1 plus R, which is 1.1. So you can see that it knocks down the value by almost 10% after a year. Okay. This is how the business and strategists look at your investments and things that you may propose. Well, what happens to that over time? Well, that's accounting for this opportunity cost of capital. Okay. Does that make sense? I struggled with this for a long time, but after I got enough of it, heard enough of it, I know what they mean by net present value. It really is about opportunity cost of capital, meaning if I'm going to take those dollars, invest them someplace else in the market, doing something else, I could make this much, so I have to discount those cash flows. Okay. That's how business people and your accountants and people, your strategists in the medical center think about these things. Well, how do cash flows need to be discounted to make this something that makes sense to them? Okay, so if we want to extend this out, then our C0, which is our initial investment, that's usually negative, right? Because that's the dollar amount that we invest to put this in. Anybody in here involved in a startup? Is anybody involved? I see at least one person. So you know what the first line of investors is for a startup? They're called FFF. Anybody heard those terms? Friends, family, and fools, people that invest your first run. And then you go to venture capitalists, angel investors, and all this other kind of stuff. So I see more and more some of the larger groups are using venture capitalists to help finance some of their groups. Interesting concept. Although what I'm finding is my graduates who work for these groups are noticing that, hey, they're really tightening up the strings on all this since they've got these venture capitalists involved. And obviously they have more of a sweat equity and they have more at stake. So they're helping kind of go over what the finances should look like in a different way. So anyway, so the cash flows after this at the end of some time period, usually it's a year, it's an annual time period, can be C1, C2, or C3, right? At the end of the first year, second year, and third year. Okay. It doesn't have to be a year, but usually that's the way they think in terms of a time period. You can't just add up all these cash flows without discounting them according to this opportunity cost of capital, okay? So this is really what net present value does. So if I want to calculate this, okay, net present value, I have to add the present value of whatever dollar amount is there, and then I have to add the initial investment, and if I'm going to do it for 3 years, I have to have my factor that discounts it, okay? And they discount it, and they have also an exponential way that it goes with time. So this is just the formula for what net present value looks like. Very, very standard, but it's a standard thing that people like to see. So if you're looking for, and we'll give an example of this, if you're looking to invest, acquire, do something, you have to think about how to calculate a net present value. Okay? So, internal rate of return, you saw on that graphic from that textbook thing on that survey of CFOs, this was almost equally as important as net present value. Well, all the internal rate of return is, it's essentially a percentage. And what we do now is we still have the opportunity cost of capital, but the only thing we do is we solve for that R. We solve for that R that's in that formula. We make that an unknown, and we say that net present value, we set it to equal, or to 0, I mean, and then we solve for R. And that R, if it's greater than, let's see, I'll show you here. If it's greater than the opportunity cost of capital, okay, we can accept the investment. In other words, accept an investment project if the opportunity cost is less than the IRR. Okay, so the IRR has to be greater than the opportunity cost of capital. Okay, and then we know investment makes sense. So that percentage is greater than what our opportunity cost of capital is. It makes sense. Now, I'm putting some assumptions in here because in reality, people calculate that opportunity cost of capital in slightly different ways, and they tie different things to it. So your accountants, they may say, well, you have to account for this, that, and there's other things that you put in there. I'm trying to make this simple to go through this, okay? But if you have experiences and you have other ways to do this, please let me know or let us know, because it can be done a different way. So if your IRR is less than the opportunity cost of capital, they would say, well, it's not a great investment, okay? So that's how the two are used. One is a net present value, one is an IRR. People I know that are graduates really hang their hat on the net present value more than the IRR, but the internal rate of return is used a lot. Anybody have any thoughts about that? Folks who've seen this before, what people like more, net present value, IRR, from our MBA folks?
So IRR in healthcare is filled with peril because it's a great tool, but always recognize IRR is a cash flow. And what Dr. Phillips spoke about earlier, accounts receivable are always high. Frankly, the prediction, he's updating 1 year ago. You can actually make an argument right now to see increased deductibles. Those cash flows are going to be taking a hit year over year over year. If you're calculating IRR data and cash flow is part of it, when your cash flow is unpredictable, your IRR is then also unpredictable. So there's peril in using the IRR. There's something called MIRR.
Yeah, talk about that if you would. I didn't cover that because, yeah.
IRR alone, just you are.
We're going to show you how it looks to calculate it. Okay, the IRR we're trying to find out if it ends up that the internal rate of return is greater than the opportunity cost of capital. That's what we want. That's a good situation if we want to invest. Okay, the downsides, and you heard some of them, but I mean, your initial investment, accounts payable, accounts receivable, those can change quickly and alter that. So it's sometimes the accuracy is difficult because of that. If the cash flows, as mentioned, are changing, that's a problem. There can be mutual exclusive products, so adding those together can be difficult, not so much so for net present value. And then opportunity cost of capital can limit this as well. So we did mention a little bit about assets and liabilities earlier, in the earlier talk and now, and I was going to ask this question, but I almost omitted it. Now I'll ask it and just see, because now you're experts on this. So we talked about assets. Tell me, and liabilities, accounts receivable, are those assets? Are those liabilities? How many say that they are assets? Yeah, how many think they're liabilities? Yeah. It's interesting. They're actually assets, and they're considered assets, particularly in the accrual accounting world, because that's the service. Those dollars technically are coming here. Now, I think you're all thinking about how lousy we get reimbursed for those accounts receivable, so maybe they are liabilities. But technically, they are considered assets, and accounts payable then, things that we still owe but we haven't paid yet, those would be liabilities. The only accounting thing that you should know about that is they're assets if they're going to be paid within a year. And so if they're not, then they're probably liabilities. And one thing we didn't get into, and I'm sure he probably knows a lot about this, and that is when things are considered bad debt, what we do with bad debt, and all that. I wanted to ask that, but I thought it would open up a whole nother lecturing session. Anyway, that's pretty fascinating to me. But okay, so here's the payback period. Now we really want to know when will we get our initial investment back? It's usually measured in years. Okay, so if I want to, this is the number of years before your cumulative cash flow then equals your initial investment. So there's some rules behind this, and that is, most of the time your period, they like your payback to occur within 5 years of most investments. Some people they get 3 years, but most of the time 5 years is out there. So things that are not good, this is the way to calculate it. You would look at your cost of the project and divide it by your average annual cash flow. The problem with that is your cash flow, particularly like some of the things we're going to talk about, it can't always be constant from year to year, even though we're going to make some assumptions like that, okay? So discounted payback, now you may have to discount this for the opportunity cost of capital as well. It changes it just a little bit. But, okay, here's our first example. Freestanding ED. I took this picture off the internet. Maybe this is your place. Maybe somebody works there. I don't know. But this is a freestanding ED, right? In Columbus, we don't have, I think Houston has the most in the world, right? Don't they have over, anybody from Houston in that area? Anybody ever worked there? I think they have over 50. In fact, a friend of mine, what's that? You work there? So don't they, in fact, the guy who's in charge of EMS there, Dave Purse, yeah, he's a friend of mine, and he did some training at Ohio State years ago. And I know he recently told me that I think EMS doesn't even take people to those anymore because there's just so many, okay? But obviously, it's a pretty lucrative thing, right? I mean, look at urgent care for the same kind of problems, how much emergency room costs are. Their costs are pretty high. Their bills go out pretty high. They can actually send out bills as though they're emergency department, which is a little bit different than an urgent care, right? Maybe that's why some of our legislators don't necessarily like this, right? So anyway, so here's the first example. We have a plan, and the plan that's on the table is your medical center, like most academic medical centers, they're slow to the table. We've waited till now double figures of these are now in the Columbus area. They're all making money. I mean, after 5 hours, you can close the thing and they still make money, whatever. And the medical center says, hey, we're going to build a big clinic here and a hospital, and we want to have a freestanding ED as part of this. So I don't have to pay any of the capital charges for buildings, for property, for anything. All I have to do is they're going to cover all this cost, and they say, can your group gear up to do this? Can you cover this? So we have to decide, hey, is this a profitable venture for our group to do? Okay, does it make sense? Okay, so what are our expenses? Again, you can all quibble with me with these expenses because I put these up with one of my administrators from my department. There's probably other things in here too because this is kind of an academician's look at this. So obviously recruiting expense because we got to recruit about 5 faculty members to work, each of them full time to cover this thing with single coverage. Okay, so that's kind of what we thought might be the recruiting expense. We're assuming it's single coverage, yet we need at least 5 FTEs. These dollar amounts is sort of where the AAMC mid-tier is, right in about the middle, $214 an hour of costs, which includes salary, CME, benefits, package, vacation, all that stuff. And here's, if we multiply the hours, we're talking about covering it at 8,760 hours. Per year costs are 1.874 million. Okay. Now that's the salaries, benefits, those packages for those 5 people, the recruitment costs, all that money up front, right? There's also malpractice. Okay. Maybe it's $10,000 a physician. We're self-insured. We do well with that. So our costs are relatively low. So that we look at that as this would be a fixed cost, right? $50,000 a year that we have to worry about every year, right? Okay, so now we have to think about this and think, well, things change, right? Salaries may increase 2% a year, so we have to factor that in, look at the cash flows, look at it could be a cost every year as well. So the cash flows have to not only reflect your dollars that come in, your revenue from your patients that go to your physician, your services, but they also have to reflect the costs of those physicians, right? So here's what it looks like. So what I'm going to do first is go through this and show you a calculation of what it would look like doing it by hand. Okay, kind of just sitting down and crunching the numbers with a calculator. Okay, and then we're going to talk about much easier ways to do it that you could do on your computers right now. Okay, or you could go to the internet and do them. Okay, so year one, I can look at this as my costs are going to be $50,000. Okay, that's the malpractice cost, and they're 1.874 salary. Then I multiply each year by 2% to get each number a little bit higher each year, figuring they'd get a little bit higher salary every year. You know, that's probably not a good estimate, but that's not bad. Okay, some years that we don't get it. Some years salaries can go down, right? So anyway, so this is what the costs look like for 5 years. Okay, so now our cash flow and our revenues based on 20,000 visits, and looking at those 20,000 as that'll be our first year, and every year will go up by a little bit. And so can we calculate a number of what those cash flows would be expected? So what we did is we used revenue kind of like right in the median of what the AAAM, for those of you who don't know, that's the Academic Emergency Medicine Administrators Group that actually does a survey of academic institutions every year to figure these numbers out. So these numbers are pretty recent, and this is what they would say we're getting per patient at the 50th percentile according to AAAM data from last year. They came up with brand new data this year. That's not that far off. Okay, so this is what I can expect if my 50th percentile at these places in freestanding ED. So now I can come up with a cash flow for every single year. All I got to do is increase this number by 2% per year. Okay, and then all I have to do is look at the dollar amount that I'm going to get on the average, and I could kind of come up with some figures, some way to estimate cash flow, right? I have to subtract from that revenue my costs of the doctors each year. Again, I'm not looking at anything in terms of technical fees, hospital charges, because realize there's going to be a facility charge, right? I mean, those people aren't just going to get a bill for physician services. They're going to get a physician. I'm not even factoring that in there at all. Okay. Another disadvantage of the way I'm calculating it, but this is what it looks like. Okay. So I know that I'm going to get somewhere in the 400,000s every year for that volume. Okay. That's what I'm going to get. Okay. So I know the cash flows for years 1 through 5. So now, again, what I'm trying to do this is, can I calculate a net present value? Can I calculate an internal rate of return? Can I calculate a payback period? Okay. So here's what we'll do. Again, by hand. This is the dumbest way to do anything, but I decided to do this calculation right here by hand using those numbers that we just had. It looks ugly. So here's what it is. Okay. So again, we multiply all these factors out. We got our cash flows. We got our initial investment. That's in business terms. If this isn't a negative, but if you're adding or subtracting something, those parentheses means that it's a negative number. So that's my initial investment. And then I just add these all up. Here's my net present value. Okay. So it's pretty positive, right? So that's pretty good. Now, it turns out that you can go to your Excel spreadsheet, and if you look up here, there's something up here that looks like formulas. I can put those cash flows down there with my initial investment. I can pull down formulas for net present value. There's actually a formula for net present value. There's a formula for internal rate of return. I can calculate those by just outlining the right things and pressing a keystroke to get those numbers. So now what I do first is I put down my cash flows. This is where my answer is going to go for the present value. Okay. And now I go and I click on net present value. It gives me a place up here, first of all, to put my R, my interest rate that I'm going to discount things at, in that denominator figure, which is 9%. We already talked about that. Again, limitations to using that, but 9%. And then all I got to do is outline that, click it, and it will give me this other value. It'll give me my net present value. Boom. just like that. Pretty similar to what I had, okay? The only difference is I have to do that by hand to take that present value and subtract the initial investment to get the net present value, okay? So, boom, there it is, okay? That's initial investment. Here's my net present value. So it's the same thing as what I got when I calculated by hand, okay? I can do the same thing for internal rate of return, okay? I can bring up that formula from that formula list, and the only difference is I will tell you for doing this, now I have to circle and include initial investment and everything on that calculation, okay? And then I just click on it, and it will appear. It's high. Internal rate of return for this investment, 20,000 visit is very high, okay? So we know I can do that. I can also calculate, this one I did by hand, the total cash flow is this. The mean annual cash flow is here. So my payback period is like practically a month, you know. So it's great for 20,000 visits. Looks like a pretty good investment for our group, right? No doubt about it. Okay. Now it turns out that you can do this. I lived on Investopedia. I don't know about other people do their MBA, but I did YouTube, that Investopedia. I'm a program director. I'm an education guy. I did a lot of research early in my career on cardiac arrest, pneumonia. I didn't know anything about accounting. I'm still not sure that I'm great in accounting. I didn't know this stuff. So I did YouTube. I did Investopedia. These are some of the sources I looked at. Investopedia was really good to me. And they actually have, you can do the same thing that I did by plugging these numbers in. Discount rate, life of the project, initial costs, and your cash flows. And there's other calculators online that you can do the same thing as well and make this even easier than even using Excel. And you can copy that, and that'll be acceptable to give to other people. So here's another net present value calculator that I ran across. And here's actually us now putting in those same cash flows, same initial investment, same discount rate. And here's what we got. Same thing. Same number, just by plugging this into some of the online calculators. Another really, really easy way to get at this data. So now we got net present value. Now you understand this discount rate. Now you understand the opportunity cost of capital and how you might come up with this, okay? So our net present value is here. Our answer is definitely yes, particularly if our volumes are greater than or equal to 20,000. We can show this to our people and say, hey, we're in. We don't have to show it to our people. We can just say, hey, we're in. We're going to be able to staff this, okay? Now, what if the volumes were a lot less, okay? You know what? If the volumes are only 10,000, it's a loser, okay? We do all the same calculations. Here, our net present value is now a negative number, okay? I don't know. I think that internal rate of return is wrong, but I think that's a negative number as well. But actually, I'm not sure what that is. It should be probably a different number. But the total cash flow is negative. We don't have a payback period. It's not a good investment. So just out of curiosity, what I did was I did another calculation. I decided, I said, well, I wonder what volume I would have to get a zero net present value. So I just was really curious about this because I started trial and error. So I finally found, I set it to zero, and I finally found that for my net present value if it's greater than, my volumes are greater than this on the average, I'm going to make money. If they're less, I'm going to lose money. Okay. So it's just an interesting calculation that I did. I'm not so sure that, again, there's probably a lot of assumption problems I had in my first calculations, but I just decided to see what the volume would look like if net present value was zero. And really, you just want net present value to be above zero. Okay. So anyway, questions about that calculation. I wanted to have a little stopping point just so I could. By the way, the cartoon says, I don't understand your questions. Could you restate it as an answer? No. So any questions about this net present value? Anybody, does that make a little bit of sense? It's really, you have to discount this going forward when you're talking about starting a project. So the next example may be closer to home, right? Everybody's doing this, right? We're superheroes now because we can do ultrasound, right? You all know this. I mean, we all do it. It's a great modality. It turns out that it can actually make money. We have now an ultrasound division, and our division does very well, okay? So here's the problem with calculating this. If we're going to try to bill for ultrasound and see if it can be a moneymaker, we got to start asking some other questions. What are the expenses? What about the equipment? Those things about like depreciation, all that comes into this formula, okay? Is there some sort of maintenance costs? how do these things change with time? Ultrasound equipment has to be updated, right? Is there an expected income? How do the charges work? If I have charges out there, how much do I actually collect on that? Okay. So what about the hospital charges? What about their technical or facility fees? Okay. When I was talking about the example when I first got up here, I said the thing that really frustrated me and wanted me to learn more about business was just, it seemed so criminal, I like that word, criminal, that our medical center was making our group pay for residents and benefits and salary because the other groups didn't have to do this. The only thing that they finally were persuaded by is in 2001, we published a paper in Academic Emergency Medicine. We surveyed all the program directors, and really we were trying to figure out what was happening in the GME world of their funding, given Medicare had come down and said, now we're going to stick by this balanced budget thing, and this is going to cost your hospitals in a different way. And that's when the cap started ballooning and really going up. And it turned out that there was a number of things that we learned, but the one thing I wanted to know was, hey, how often do groups have to pay for resident salary and benefits? Well, you know what? It was pretty infrequent. It was only about 3 to 5% of all programs. Now that, rather than me whining every month like I did for a long time, that had a lot of power. And so that really helped me know, hey, you have to get more of a business knowledge for this. So anyway, let's go through this example. Some of this was done by one of our students who had a big background as a financial analyst. So he actually did this at first. So these are some of the initial costs: total equipment for 2 machines, maintenance agreement, QPath license. This was our subtotal. This was our sort of initial C0 cost to put into the system, right? And then we started talking about, well, what kind of revenues can we expect? What's the physician fees that we can collect? Okay, are there technical hospital fees? We actually made some estimates about what those would be. The reason I was bringing up the previous example is if you think it was hard to find out what the DME and the IME dollars were per resident in your medical center, good luck trying to find out technical fees for charges for things like ultrasounds, because that's really a big black box. And people don't want you to know. They're just really hard to find. We did make some estimates, and here's what it looks like for physician income and their technical fees collected and total operating income, okay? Total cash flow. So we came up with expenses and we came up with a cash flow line in the bottom, okay? I'm going to show you some data that it doesn't, interestingly enough, we're to the point where we're getting close to these numbers anyway, but initially this wasn't that profitable, but this is your operating costs that take into account what we had before. So you can see this kind of looks like a different kind of a spreadsheet, but again, it's putting the numbers and the cash flows down, okay? Now we can actually look at this. Now this is exactly like we had before, right? Here we have our cash flows, okay? We have our initial investment that we went over, okay? And now our net present value for all this is $66,000. Our internal rate of return is 15%, way greater than any opportunity cost of capital. It's in double figures, which for medical systems, they're usually in high single digits, if that. And now we have our total cash flow and our mean cash flow, or our mean annual cash flow. We can calculate our payback period is 4.8 years. Okay. And I thought that was a really compelling and interesting development. Now, what it has led to, and by the way, this is actual data. This is actual data. You can see that our charges and our payments, we only collect about 22 to 24% of what we charge, but we are getting dollars. Here's where we are right now. And fortunately, we've got a pretty aggressive ultrasound group. We've been doing this since 2010, but now we're starting to get more dollars that's coming back to us. I think the indirect things that happen, maybe the intangible dollar flows that have come in with this, is because of the credibility of this billing service, that we're the only ones in the hospital that use QPath and do this. Now other departments are wanting to get on board. So one thing that I didn't put in here is we're actually looking at coming up with a business plan or a pro forma to say, hey, if we educate other groups, how can we charge for that and make that a business model? Because right now our medical center is funding our director and a certain percentage of an FTE, and our College of Medicine is funding our ultrasound people to teach ultrasound within the College of Medicine. So that's a credible ultrasound. Those are sort of fallouts and income streams that we didn't, see coming. So I think that was a big benefit to us as well. So that's ultrasound, okay? Questions about that at all? We got about 5 minutes. Is that right? 5 minutes? Okay, 5 minutes, and we're going to kind of cover this last concept, okay? And hopefully maybe we'll have some questions at the end if you have ultrasound. So the whack is not wacky, okay? It's not wacky Wednesday. That's maybe tomorrow. Around here, it could be today. I don't know. But it is called the weighted average cost of capital. This is thrown around there a lot, big organizations, big companies. I'm going to show you 2 calculations if I have time to do this. The second one I'll gloss over. You can imagine this kind of calculation is very different if you're a for-profit entity or a not-for-profit entity, right? So I'm really going to talk about first, this is really talking about the whole value of the company in terms of the amount of debt and equity. I'm also going to let you know about some people that have actually gotten Nobel Prizes working on some of these techniques and these things. But companies usually finance their assets either through debt or equity. Cost of capital, we talked about a little bit. It really means the expected return of all the company's existing securities in each category is then proportionally weighted. And we'll talk about that in a second. If a company's return is greater than their WACC, okay, then they are creating value. Okay. If it's less than their WACC, okay, they're losing value. Okay. That's a kind of a quick way to look at this. Okay. So if they have a 20% return, their WACC is 10%, they have a yield of 10%. That's creating value. Okay. If a company's return is less, we talked about that, they're losing value. Okay. So here's how the formula goes. This is overall value of the company. This is debt, this is equity, and this is the factor that we have to determine for this. Okay. The after-tax WACC, you would put in a 1 minus 0.35 if it's a corporate business percentage for taxing or whatever that is currently. Obviously, if it's for nonprofit, they may not have a tax burden, right? So that's something you have to account for as well. So our terms are, this is the value of the company, debt plus equity. It's the total value of the company, okay? Interest rate of the debt, okay, is R sub D, okay? The rate of return of the equity, which may be assets if it's more of a nonprofit, or equity could be more stock if it's a company, and I'm going to show you an example of both. And this is how to calculate this R sub E, which ends up being pretty complicated. This is from something called capital asset price management. We'll talk a little about that because the person who developed this concept actually did get a Nobel Prize, okay? And we'll talk about what beta means. Beta is actually a number that is, if it were 1, that would mean that your stock is varying exactly like the market is. Usually it's like the S&P 500, okay? If your beta is 1. Actually, every company on the stock exchange has a beta. You can go look at it. You can find it on their website. You can find it on Google Finance, and I'll show you where you can find it. So that is against the market rate of return, what theirs is. One exercise we had to do is we had to go and we had to graph the returns over time and calculate what a beta was. So it's not, but usually you can just find it, okay? This is an example of what it is. It's really kind of rate of return and what the market is doing, okay? This is just how to think about it, okay? So this is William Sharpe, who earned a Nobel Prize in 1990 for this capital asset price. And he was a big one that was, the theory was that the value of your company doesn't matter how much debt and how much equity you have. It's the overall value that makes up your value. So you could be in debt and still have value. So here is from Yahoo Finance. This is where we went to get our stock exchange. We had to follow a stock as part of our finance class and stuff like that. And so you can find things like the beta right on here. Beta for CDS, that was the stock I followed, was 0.85. Okay, so that gave me a chance to solve for this. And I could find all these different things. U.S. Treasury bills, this is the conservative rate of investment, which is R sub F. Okay, and I want to find out what it will be for the market-related value. Beta was 0.977 because I had to calculate it. That's what I came up with. And I could solve for this R sub E this way. I'm kind of going through this a little quickly just so I can get to the end of this. So the R sub E for CDS was 9%, okay? Now, so that means I can come up with numbers for each one of these. I can put a debt over value. I can put an equity over value, all from that page that I showed you, and I could come up with the overall value, and I can come up with a formula that gave me a WACC of 9%, okay, and a return on equity of 12.23%, okay? And since their return on equity is greater than their WACC, it's positive. So they're adding value, okay? I can do a similar thing for a nonprofit. I'm just going to go through this really quickly. But this is a little bit differently. Now I have to use their balance sheets a little bit and come up with what their bond rating is and the value that way of determining what their equity is, because it's really their net assets are a little bit different than stock assets. But I can go to these websites and come up with their bond rating. This is the WACC for East Tennessee Children's Hospital. This was an example that I stole from Kiel. Okay, he's very familiar with this because he had to use this. And basically I could come out and come up with their R sub D for the debt percentage would be 2.285. And then I could come up with what their R sub NA, which is their net assets, is 9.7. So now if I want to solve for WACC, I put the same formula out there, and let's see, their WACC is, it's a 8.5%. Okay, that's what I get by putting all those things in the numbers. So that gives me a WACC for a nonprofit. Now realize there's a lot of assumptions in here. I mean, to come up with, I mean, there is no beta for a nonprofit. So what I have to use is a for-profit similar hospital to kind of make that extrapolation. So but you can still do this kind of math and come up with this kind of calculation. This is Miller and or Modigliani and Miller, and they did also got a Nobel Prize really to talk about the WACC. And so just to show you, some people have really gotten a lot about this. So here's my summary. We introduced a number of financial terms, okay? Net present value, IRR, WACC, and also payback period. We talked about these formulas a little bit. They're all out there. They're easy to do. Our examples were freestanding EDs and also ultrasound programs. And then we calculated a WACC for a publicly traded company as well as a nonprofit. So I'll end with that. I took this picture from the World of Americas last night. It was a beautiful sunset, so I captured that. So questions, discussion items. We went through the WACC a little bit quickly. How about people who are in this MBAs in that group cohort? Tell me how you've seen WACC used.
Okay. WACC is, so WACC, for-profit, is more often used in for-profit type companies. Just like Dr. Martin detailed. I asked that question of our executive VP of finance when I was doing my MBA. Like, okay, I'm going to spend all this time calculating for several companies, different WACCs. How do you use it? Because I don't even know ours. You don't know your WACC? My professors are telling me this is everything. No, I don't know my WACC, but I do know our rate. And that's a bond, basically. That's what really counts in not-for-profit land. Mm-hmm. That last bit that Dan went over, where then, is there anybody here who's in a for-profit institution? Okay, so we're all in the same boat. When you're doing a weighted average cost of capital, basically, what does it cost for you to get more money into your institution? The only thing that any sort of financing entity is going to look at is your debt ratio. Well, where does that come from? Well, it comes from bonds. Take that beta, and Dave's exactly right. You just compare that to an equal company. So you compare the bonds that your not-for-profit company, I won't tell you how to get in a second, that your not-for-profit company is using, and you compare that to a similar bond rating and amount of bond in a for-profit. And that takes a little bit of sleuthing. There is someone in your institution doing that, I guarantee it. Now, when I asked my executive VP of finance, okay, man, what are our bonds? You can list them all. You know, 16 major bonds that the Roanoke Health Municipality, I believe is what it's called, that you can actually look up. I found the rating for that, I found the amount for that, and I went to a site called FINRA that has every single bond in the country, and I compared those side by side. Okay, great. Now I can come up with a beta. I went to comparable bonds, and I went to that place, those companies' sites, and I can find their beta on Yahoo Finance or on the Bloomberg terminal, which we had access to. And you can find, okay, that's the beta. that is stratospheric finance that you guys have just gone through. Into the question.
No, the only other point I wanted to make was to your point, and that is when I would go to my administrator, who's an MBA, great administrator, and he has been an administrator someplace else before, and I was showing him my calculations for net present value. Just because they're an MBA doesn't mean they use those terms often. So there's people that are MBAs that are strategists that do nothing but evaluate acquisitions, projects, things like that for you. But your run-of-the-mill MBA like that, I don't think my administrator knew that much about this, so he certainly didn't remember even the WAC and stuff like that. However, I think when you're talking about larger projects, trying to sell your department or somebody on how staffing a different department or something like that would help, or maybe even a business plan for having a group of educators, for example, who would be able to teach ultrasound to a community ED group. Well, that would be a win-win if you turn that into a business plan. I know another group in another state, they have a group of docs. They get so many calls to cover departments that now they formed a small business to basically supply docs to those places really quickly. They charge a lot for it, but they have a business pro forma and a plan. So I think to the point that Damon and Keel made to open this up and Farhima about this is those business plans, those ways to think about that, those are the keys here. So I'll stop there. Thanks.
Yeah. All right. Wow. So the captain has turned off the seatbelt sign. Everybody can get up and walk around the cabin. That was huge. And that was really, I think, between those first two talks, you guys really just got the first 2 months of an MBA program. And I'm not kidding. I mean, each one of those slides that Dan just put up, that's a day's work in MBA land. You will have these slides by the end of the day. You got to. I have asked, I've roamed down the hallway. The board meeting is happening right now, so the folks that do that are actually engaged in there. But you will have these slides, because I think you could spend, as much time as you want on each one of them. Those were critical definitions that Dan Martin just put up there. Critical in terms of having a global understanding of what your institution looks like. Let me give you a couple of other pearls, like some secret teaching here. None of this is secret. Do you know that all of the finances of your company are available online? You could go right now, and I'm going to tell you the site, and go and look up, okay, what is the balance sheet for my company? What is the P&L? What did they actually claim that they didn't need to pay in taxes, right? That's what not-for-profits do. Are they actually not making any profit? No, we all have money to get here on a plane, right? And I hope somebody got a decent dinner in town. You paid for that somehow, and it's because they're making enough money to actually pay people, and they have a little bit of margin year over year so they can actually expand and keep paying debts. GuideStar.org. Free membership. If you want to pay a little bit, or if you can talk your chair into giving you a little extra cash and getting an advanced membership, there is tons of data there. What I want you to do is when you join, you just sign up, put your email in, and they don't spam you. It's not a bad company at all. But every not-for-profit in the country is listed on GuideStar. Right-hand side of the screen, when you hit Financials, go to the Financials tab, right-hand side of the screen, you'll see the Form 990. So that's what not-for-profits file for taxes, and I put that in quotes. The 990 is not just a balance sheet, though. It's not just a bunch of rows with numbers aside. It actually describes what they're doing. It's a lot of the fluff that Dr. Ardolik was talking about. The vision bit that you put in your business plan, well, they've got some of that. There are always pearls in there. There are strategic pearls. I was shocked to see in my review of our 990, I guess it was 2 years ago. And by the way, these things usually lag by about 12 months. They'll take as long as they can to not report. But to see a strategic plan around my emergency department that I didn't show to my chair, who was very interested in it, because he had talked this over in our C-suite,
but it wasn't something that was front and center for him. That was corrected within a couple of months. Like, okay, this is actually what our department's doing. You will learn a lot about your institution. You may learn a lot about your department, and shockingly, you may learn something about yourself that's described in those 990 plans. The twin to that in the real world, so real profit-making companies, is sec.gov. If you want to see how the real people do it, go check out the 10K. I'll tell you, the best example probably is Pepsi. Everybody recognizes Pepsi. So US-based company, their description of how they do their P&L and how they do their cash flows is fascinating. So evidently Panama is their greatest profit center. Do you really believe that? Is Panama where they're making all? No, but it's where they're reporting it. There's great advantages to doing that. So sec.gov, guidestar.org. If you're really interested in that last bit of Dan Martin's talk, FINRA, FINRA, is where you can find any bond rating. It's a little bit of a cumbersome site, but in the big banner at the top, you can put in your location, so your city. If I put in Roanoke, Virginia, I get about 200 bonds. I put in healthcare behind that, and it drops to around 30. And then I can actually find the ones that are targeted to my institution, and you can get a pretty good idea of what kind of debt they're financing. That feels secret when you're talking to these folks with C in front of their name, like, oh, they know this. No, it's actually all public. It's out there in front of us. We just have to know how to look for it. Questions right now? Yes? I'm sorry. I'm tinnitus. Mm-hmm.
How do I figure out, I don't want to know all of Rutgers, I don't think. I want to know maybe the medical school part of it. Otherwise, it's the biological sciences. Like, how do I navigate through that?
Yeah. Great question. So she's at Rutgers and she's saying, I don't want to know all about the Rutgers as a whole. I really am just interested in the healthcare portion, and maybe more importantly, the health education portion of Rutgers. So that's an excellent question. I'm glad you put it out there, because I had the same thing. When I look up Carilion Clinic, I found 6 different things that had foundation, healthcare, and medical school, Virginia Tech Carilion Medical School. There are all these different listings. The painful answer is that you got to sleuth a little bit. You're going to have to look at each one. Something that might help you if you've got a title for your major academic hospital, like ours is Roanoke Memorial Hospital or Carilion Medical Center. By the way, they each have a line item on GuideStar. I had to look at both of those and then kind of piece out which one is the actual academic bit versus the money maker, which is really most of our procedural services. So we have, we are members of the only private public medical school in the country. So Virginia Tech Carilion, it's about to go all public, coming under Virginia Tech this year. So the way that this has been termed is that the medical school is embedded within Carilion Medical Center right now. They are about to be separate entities. And in about a year, I'm going to have to look under Virginia Tech College of Health Sciences in order to find out any details about the medical school. Currently, I can find listings for different departments, and they actually put in their description statement of their cash flow sheet what they're paying out in terms of academics. So, and I think my supposition is this is protected time that's given for people for doing education and being faculty members. Does that make sense? Does it to me, so yeah. Yeah.
Just to add one thing along that point, lots to give to their own board. So sometimes you find those. I've seen them from multiple schools, so it's a nice way to start looking for private school. Actually, probably more likely it's private school. They have to report to somebody, so you might want to dig for something like that. And those, usually, if you go online and you have the right combination of words, Google is your friend. You can find some really interesting things.
Phil, did you have a question? Okay. Thank you. Any others? All right. So We have scheduled lunch at 11:30, and that was strategic. I'm hoping that there is food out there. We wanted to give a little bit of walk around time, a little bit of a break before we get together into our different cohort groups. I also hope that we would get like first dig in so that all the veggie, boxes weren't gone. So the way this is going to roll is get up, stretch, move around a little bit, and restrooms over the way, right down the hallway, and to the left. And then grab a lunch, and I think meeting back in here, and then you can break out wherever with your different faculty members. Let's go back over those again. So Dan Martin, if you turn around, he's at the left side of the table. He is in green. Dr. Ardolik is in blue, so all the blue guys go with him. Ryan is sunny yellow. Dusady is red. Damon in the far back is hot pink, and I'm orange. So we'll be meeting you back here in just a few minutes after everybody gets a little bit of lunch, and then we'll just take a little time to introduce ourselves to each other. And if you already have a project in mind or you wanted to ask questions about the project, please, that's your time to do it. Thank you for this morning.
Yeah. Yeah, exactly. There you go. Thanks for this. So far, the best combination of very good theory, great dreams, great motivation.
Talk about that aspect and realizing I really knew about all of that. They try that is very important. And then it has a leadership lesson. So I create presentation for my leaders and frequently when we're talking about these things, the higher level challenge we have to go through. I just realized I didn't know nearly as much about it as I would like to. Sometimes I get interested. She escaped that when for discussing what she had for the first introducing this course.
No, we won't get I love it.
They did go well. Yeah, they really are.
What we can do, I think, is think about trends. I can even see